Today, folks, I'm going to take you through my portfolio during this market that is crashing to give you a clerical view of the performance of the account, where we currently sit with the stocks that I'm buying. We're going to look forward at stocks that I think are actually trading at discounts right now in the tech sector after earnings. We'll talk about some Canadian stocks like Enbridge and so much more in between. So if you're on a path to financial independence, to perhaps one day retire early, go down there, hit that subscribe button and join me, and hit that like if you appreciate these weekly videos, especially these portfolio insights in a time where the market is absolutely getting eviscerated. I mean, the Qs today alone are almost down 3%. VOO, the S&P, when it's doing 2% movements, has been quite peculiar in the last year. SCHD is getting hit pretty hard today, with the exception of Apple, which is surprising because I believe it was red after its earnings, is actually coming back. Amazon's down 10%. Meta, I mean, Tesla's down 4.3%, almost back into the low 200s. Maybe we'll dip below that. Palantir getting absolutely wrecked here. If we take a look at the heat map, it seems to be more of the AI-oriented stocks that are very hindering the market. I mean, you know, Microsoft was extremely expensive. Nvidia, all these tech companies are starting to come back to a realm of normality because we're in a correctional period less than we are in a crash or some bubble bursting, in my humble opinion. And honestly, I think we're starting to see what will potentially be the latter part of the sell-off because valuations are starting to make a lot more sense, in my opinion. But this is why I told you guys I'm very flaky. I mean, I'm flip-floppy. When I see Tesla run up from the, we're buying it at around the 180s, 170s here, and it runs up and we make a quick 40, 50% returns, why I take those profits, because there's nothing to justify these run-ups. And a lot of people have been buying stocks at the all-time highs thinking this is the time, we're going to make all this money. And they're like, oh, I'll buy it if it drops. But when it drops, they become super quiet. And I hope that's not you. You should be taking advantage of these drops because there's major, major discounts. And what I think is hilarious is people that think they know what's going on by formulating numbers and presume this is a game of numbers. If numbers and earnings meant anything, stocks should stay flat or at least go up a bit. I mean, earnings were great, right? But you look at companies like Intel, and the reason I'm pulling this up is because there were so many people out there, like Everything Money, that were making videos like this saying, here's how Intel can still take on Nvidia. This was 9 months ago, and he disclosed in this video that he's been buying Intel. And then, he posts these videos. Again, this is the same video from 9 months ago saying, this stock could be anywhere from $30 to $62, and I'm buying it. There's big potential here. This company could beat Nvidia. And what ended up happening? The exact opposite, because past performance doesn't equal future return. It's all fugazi. You can't sit there and read numbers and run calculations and think you know something about markets. I don't work for chip providers. There's something clearly wrong with the fundamentals of this company's business. I mean, they're deteriorating. So you can't run traditional value metrics on a company that's deteriorating unless you know something about the future performance, which means you're an insider. I'm just saying. Nancy Pelosi, right? But bringing this rounded conversation into my portfolio, which is down a lot more today, this isn't taking into consideration the drop from today specifically, but we're still in a really good spot because I have actually been buying VNQ pretty aggressively here. I'm looking at picking up some more S&P and even some VDY. So I have been contributing quite a bit to the portfolio just within the last couple days. The portfolio value luckily is still well over 300K. We really kind of overstepped that hurdle, which was great. And I'm actually looking at taking up some major discounts here, I think, with some of these stocks because it hasn't been actually that often as SCHD. VNQ was actually ripping through most of this market volatility, which was great to see. VOO has been the most volatile in the portfolio as it seems to be because of tech. But honestly, my goal here is to get this up to 400,000 as quickly as possible. I want 200,000 in VOO. I want about 100,000 in SCHD, which I'll have to wait till next year because that's my RRSP and I got to wait for more contribution run. But we are over 90K, which is awesome. VNQ, I wouldn't mind getting, I'm not sure where I want VNQ to be in total, but I'd like to see about another 100,000 spread between 2 or 3 ETFs, being VDY, VNQ, and perhaps another one. And that way we have a 50 split, about 50% in VOO and then, another 50% spread across 4 other ETFs, and that would give me a 400K portfolio. I believe I've removed a lot of volatility out of these accounts, and to show you guys something no other YouTube will show you, no other YouTuber when it comes to Everything Money. I mean, there's so many guys out there that don't do this, and I pride myself on this because, I've been saying that I want to outperform the market, and that's the point of this YouTube channel, is using the markets to to accelerate my financial independence to perhaps one day retire early. So here are the actual stats from the run-up. This is in August. This is just into July, to the very end of July. My TFSA hit a new record high, and we've had some flat periods because the performance is represented by the blue line, and we had a period where I liquidated this account to buy real estate, which was this flatlining period in 2023, and we are still above the NASDAQ and the S&P 500, and it just hit an all-time high in July from a percentage rate of return. We're up 202% since July or June of 2017, which is insane, right? The S&P is only up 128% and the Nasdaq's only up 183. So we are still crushing in this account. If we take a look at my RRSP here, and again, this is really having a lot to do with managing, taking Google gains, taking Tesla gains, and mitigating it into stocks that were less volatile, that are still actually up from where I sold those stocks. Like V&Q is still up from where I bought it, and same with VDY for the most part. But if we take a look at the RRSP, we're up 302% just since 2019. I wish this was my TFSA, but that's insane because the S&P is only up 85% and the Nasdaq's only up 115%. This is my best standing account, and again, all these gains can be contributed to mostly Tesla. And as it stands today, I only have SCHD in this account because again, we just recently sold some Tesla out of this account too, right? So we crushed it. I mean, we have been just patting myself on the back to be back at all-time highs, especially after a big real estate purchase and a liquidation of these accounts. And even my oldest account, I told you guys I'm almost 10 years into my investing career. I started investing in September of 2014, and in my first instance of investing within the first year, I mean, we were like 6 months into investing and my accounts dropped almost 50%, and I didn't even see any capital gains or appreciation or dividends or anything until about mid 2016. So we started in 2014, we didn't see any gains till mid 2016. So I want you to keep that in mind if you're a new investor. Sometimes it takes a little while, to get into your groove, but even still, I haven't had any money in this account, again, since I purchased real estate, and even now I don't have money in this account because I'm trying to take advantage of the room in my tax advantaged accounts, and we are still up 328% when there's no stocks in here, and the Nasdaq and the S&P haven't even come close to catching up yet. The Nasdaq just kind of touching it though, but Nasdaq's up 284% and the S&P's only up 175% at the same time. My rate of return is insane. I mean, it's like 30-40% compounded, probably higher than that. I mean, these numbers are truly jaw-dropping and quite incredible. And if we just take a look at where the portfolio sits today from from all these ETFs and how they overlay and into individual stock positions, this is my sleep easy night at my sleep easy at night portfolio. As many of you know, you kind of got to build in your own comfort level, and this is what makes me super comfortable right now. Is no more than 20% information technology, 18% financials, 11% healthcare, 9% energy. We're building up that real estate exposure now at almost 4%, with the top weighted positions being Microsoft, Nvidia, Apple making up over 10% of the portfolio, Amazon, Royal Banks in here, Meta, Alphabet, Home Depot, AbbVie, Cisco. I don't really need to go through the rest, but this is a beautifully well-rounded portfolio for me to be sleeping easy at night, especially in the midst of this earnings season where we finally got a full encapsulated view of what's going on. And I'm not sure if I'm going to take advantage of it, but I'm seeing some pretty big discounts in some individual stocks. And this also shows you how hard it is, even buying the S&P top 10 companies, it is to outperform the S&P 500, because a lot of what we're about to look at is not actually keeping pace with the total market returns right now, which even with these drops is still up 12%, right? So keep that in mind. This is why I focus so heavily on indexes and really fixate on a few individual stocks that I think I have a better grasp on. But we're just seeing, again, a correctional period. We're only seeing multiples compress a little bit down here. We went on this wicked run, and people, again, wrapping their heads around why, because we just got overbought. It's very simple. Earnings are good. These are true buying opportunities when we finally see corrections, when earnings actually came up pretty astounding for the most part. Alphabet posted great numbers. It's up 19% year to date and is now pulling back down 13% with a 24 PE right now. This is a good buying opportunity if you believe in Google. Google's 24 PE is actually below the historical norm because typically it's trading 25 to 30. So when it dips down into the lower 20s or even into the teens, which is a rarity, this has been a screaming buy and likely will continue to be. I mean, you take a look at Meta in kind of the similar boat here at a 25 times multiple, and one of my favorite stocks of all time. Thank God the wife is still holding on to her shares. I mean, this thing trading at a 25 times multiple is actually more at a historical norm for it. So again, I'm not saying huge discounts here, but more nominalized buying opportunities. This is a more normalizing market, in my opinion, compared to the historical averages. You look at something like Apple, which I think is still really pricey here, and I'm not looking to buy it, considering it's trading at, again, you're trading in the mid 30, almost 35 PE right now, and a 35 PE is well above all historical norms. I mean, this is a record PE for Apple during a time where they have very little to no earnings growth, right? Like, I mean, their revenue growth is flat. I mean, don't get me wrong. I mean, their EPS has been growing, but when we just take a look here at revenue and profit, there's just been nothing happening to justify these costs, in my opinion. And you could almost say the same about Microsoft. Yeah, ChatGPT is incredible, but unless ChatGPT and OpenAI or whatever becomes public to justify the value they invested in it, it's a losing money business, right? I mean, they don't make any money on that right now, and the stock's now down 13%, with still a 34 times price multiple and underperforming the S&P 500 this year. I mean, it's not really just. This is the upper end of its multiple through its entire history of the company, right? So if we take a look at revenue, however, it is still, back to a normalized place, and the earnings that came out were pretty great, but not enough to justify an all-time high price to earnings multiple. So those two stocks are a little overpriced, whereas Google and Meta, I think, are coming back into the buying range, along with Nvidia. If Nvidia keeps up the growth rate that it's had, even if it starts to slow down a bit, it's actually trading at a more favorable price to earnings multiple for its historical norms. If you take a look here, actually, Nvidia, even in 2020 and in 2021, was trading to an 80 to upwards of, 80 being a fairly normal, PE, even up to over 100. So when you get down to a 50 to 60 times multiple, this is actually a fairly favorable place for Nvidia if you believe in the company. Now, when it comes to Amazon, I can't really wrap my head around this one. I never have, because price to earnings means nothing. Their cloud and Azure still continues to grow at double-digit or 30% clips, almost 29%, but still absolutely astounding stock here. And when this thing dips, it's always been presented as a buying opportunity, but I mean, it did dip pretty heavy into 2023. I mean, the stock did drop 50%. So do keep that in mind. Now, I've never been able to wrap my head around Amazon, purely because all the revenue comes from people like me utilizing them to do transactions, and they write those transactions down as revenue, but all that revenue pretty much goes to people like me that are the actual, retailer. And so the revenue isn't really justified here, and I don't know what their margins are on it, because they're still kind of losing money on e-commerce, whereas AWS is where all the real growth comes from. It's still an astounding business, and when it dips, it's usually a pretty good buying opportunity, but Amazon's always been a questionable one. I've never been able to wrap my head around it. So that's kind of like the tech industry. I'm very excited to see now Canadian earnings come up. We just got Enbridge, for those of you that are huge dividend players, and Enbridge, in the backdrop of a very red market, is doing quite well. I mean, it's up 8% this year. It's rallying on its earnings. Enbridge being the bloodlines of North America, the largest pipeline company in North America, and did pretty good at $4.33 billion of EBITDA. Bottom line ended up hitting after some increased costs, especially on financing costs, because again, acquisitions are coming into play. Still really great earnings at $1.34. This is an incredible company that proves to remain stable, and it looks like they're coming into closing, hopefully sooner rather than later, on the deal that they're trying to buy for that natural gas company based in the States, because that natural gas company will make them the largest natural gas powerhouse in North America. So, I mean, lots to pay attention to here. Enbridge is really cool. The whole markets are fascinating right now, and I hope you guys are starting to take advantage. Like I said, I've been gobbling things up here. I look to continue to pray to God we stay in these suppressed markets for longer, because I'd rather the stock market be down than up, honestly. It's great seeing, we all get excited when things go up, but people do stupid stuff when FOMO kicks in. And I feel a lot of people right now are probably annoyed their stocks they were buying from the highs are probably down a lot. But I'd love to know what you're doing and what you think about this in that comment section below.